Good afternoon, and welcome to this month's webinar presentation. The scrolling slides moments ago filled you in on the CEs and other important information. If you missed any of that, please be sure to visit the education pages of our website. Again, we welcome you. Today's webinar will qualify you for one CE, but you must stay logged on for 50 minutes. You'll receive your proof of attendance within a month. We'll take all questions at the end of the presentation verbally, but you can submit questions on the screen during the presentation. As a reminder, this webinar is being recorded and will be posted to our website within a week. So if you have colleagues who couldn't attend today, please let them know they'll be able to view the presentation. And now, friends, Romans, countrymen, lend me your ears. A bit about today's webinar. Insurable or not insurable? That is the question. Shakespeare and his wife Anne Hathaway had 3 children, one of them named Judith. Little known fact, but that, along with her experience and expertise in the insurance industry, give our own Judith Maurer the credentials to present today's topic. You probably know that Shakespeare was widely regarded as the greatest writer in the English language. You may even know that he collaborated on many of his works. But I'll bet you didn't know that he collaborated with LLIS on making today's insurance webinar creative. No, that's not an oxymoron, insurance and creative in the same sentence. Shakespeare's works remain highly popular today and are constantly studied, performed, and reinterpreted in diverse cultural and political contexts throughout the world. So join us as we reinterpret some of his titles and excerpts into a look into the insurability of your clients. Your presenter today is known as a tireless industry champion, especially skilled at overcoming underwriting challenges by pairing the right policy with the right person. She's the CEO of Low Load Insurance Services, responsible for the innovative insurance support services our company provides you and your clients. Please welcome our speaker today, Judith Maurer.
Thank you, Dina, for that nice introduction. I appreciate that. And welcome to everyone. Yes, Shakespeare asked the question, are you insurable or are you not insurable? And it's probably a question you are often asked by your clients if insurance is something that your clients are considering. So today, we are going to cover what's in a name. We are going to talk about the types of insurance and the differences in underwriting that are involved with types of insurance. We're going to talk about what's past is prologue, and that's the fact that history is important when it comes to using an insurance application. Truth will out. We'll discuss how insurance companies verify their information. We'll talk about how legacies save time. We need to pay attention to what's past as far as your clients are concerned. We need to consider medical records because what's done can't be undone. And we need a chartable assessment to tell what's a foregone conclusion when it comes to insurance. So all the world's a stage, and that stage begins with the entr'acte, and that is pre-underwriting. What's in a name? There are some basic types of insurance, and not all of them require extensive underwriting. Annuities, for example, don't have underwriting unless there are certain kinds of impaired risk annuities, but they're pretty rare, and it's unusual for anyone to be interested in that. But there are some underwriting, but not for most annuities. Term insurance is very detailed, and your clients are asked a lot of questions if they're applying for term insurance. For permanent products like universal life, guaranteed universal life, survivorship life, or whole life, the requirements are a bit more forgiving, though lots of information is required. Disability has a different focus. The emphasis for disability insurance is on the duties of the job and the financial information involved. People who apply for disability insurance need to supply far more information regarding their finances than with other products. Long-term care has an emphasis on lifestyle and mobility, and we'll touch a little bit about on each one of these products and how they work. So let's talk first of all about an acceptable risk. What is an acceptable risk for a life insurer? And this is only in the broadest sense that a proposed insured with a reasonable life expectancy without factors that would interfere with their life expectancy, such as health, family history, financial loss, and lifestyle. So if someone is proposing insurance and they have these things without anything that would be a red flag, that person is probably an acceptable risk. Disability has a little different slant. What is an acceptable disability risk? It's a proposed insured with an occupation where the ability to do the job can be measured and which does not put the insured person into a high-risk position. Examples would be like a dental practice where a dentist could see so many patients in a day. You can measure how many patients he can see. And if somebody is in a high-risk position, for example, a woman who owns a landscape company, and if she's actually putting on a hard hat and working with her crew that's putting in new landscaping, she's in a higher risk position for an accident. So disability insurers consider the health and family history of a client, the location and type of work performed. And it's interesting that one thinks that if you work out of your home, you're probably in the safest environment. But most accidents occur in the home. And so if a person is working only in their home, it can be an underwriting challenge. Not insurmountable, but nevertheless a challenge. Financial underwriting is particularly important to insurers. And this is where they are going to ask for lots of information for an applicant regarding their earned and unearned income and their lifestyle. So last, what is an acceptable risk for a long-term care insurer? And again, this is a proposed insured who is currently, and the emphasis here is on currently able to do all of the activities of daily living without assistance, limitation, or pain. For example, assistance would be some sort of an assisted device, like a cane or a walker. Limitation would mean that they aren't able to move as flexibly as they would like to be able to, or if movement causes pain or they are in chronic pain from any number of conditions. Even migraine headaches can be a challenge for underwriting. So these factors for a long-term care insurer are health. Is there acceptable risk for health, acceptable risk on their lifestyle, and acceptable risk with their living arrangements? It is known that people who live with someone else tend to live longer and take care of themselves longer because they have some assistance. A person living alone is more likely to need assistance earlier. So, what is the job of an insurance company underwriter? In a very broad sense, their job is to sort people into two classes. And those classes are people who can be insured and people who can not be insured. But underneath those two categories, there are lots of special classes. When it comes to people that are insured, they are usually preferred, standard, or substandard. Now, there are all kinds of classes of preferred, and we'll talk about that in a minute. There are a couple of classes of standard, but the majority of people fall into the standard class. There are substandard rates, and we'll talk about that in a minute, exactly what that means. But what about those people who are not insured? They are either postponed, declined, or the file is closed. And we'll give you some examples of that. Not insured may mean not right now. Here's an example of the substandard classes. Substandard is often a table rating, and that is based on a % extra of mortality risk. Sometimes a flat extra is charged on a policy, and that is a rate per thousand. Might be $2.50 per thousand, flat extra. It might be for a medical risk. For example, someone who has a specific condition, but they haven't had it very long, so the insurance company charges a 2 or 3 year extra charge, so that's a medical risk. But many flat extras are charged for non-medical risks, like scuba diving or pilot activities. Exclusions are another kind of substandard class, and that is most often used with disability insurance. For example, if someone has a history of back issues, they are probably going to have their disability policy issued with a back exclusion. In other words, if a back injury prevents them from working, that would be excluded from the benefits paid simply because they had that condition before they ever bought the policy. So that is just excluded from coverage. When it comes to life insurance, there are lots of classes, as you can see on the left, the preferred classes, standard classes, then there are smoker classes and table ratings. When I first started in the insurance business, those many years ago, there was only a standard class and male and female class. Then they started dividing into smoker classes, and now, as you can see, particularly for term insurance, there are lots of classes. Long-term care insurance, by and large, has standard for almost everybody. They do have some preferred classes, but it's pretty hard to qualify for those, and they often have Class 1 and Class 2. Disability, again, has some preferred, but it's very rare. Most people who apply for disability have standard or select class ratings. They may, on the other hand, have exclusions, even though they are standard. Here are the common terms for life insurance. And it's interesting that preferred plus is sometimes called preferred best, super preferred, or elite. Standard plus is sometimes called select standard, and it's just a person who's slightly better than a standard risk. And of course, then there's substandard and the preferred smoker and standard smoker. Someone asked me recently what it took to be a preferred smoker, and that simply means that it's a person who uses some form of tobacco who qualifies in all other ways for the preferred rates. Here's an example of a table rating. This is important because it has to do with how the premium is calculated. If you look at the top of the chart where it says standard rating, you will see that a standard rating is known as 100%, and that is, sorry, I tried to click on the wrong thing, and so we have an operator error. But I can talk about this while we go on. If someone is considered a standard risk, their table rating is 100%. If someone is considered, and in this case, if we translate that 100% into dollars, that would be $100. If they are table A, that would be a 25% extra, and the table A would then qualify, sorry, I'm having to do this. The table A would then be $125 charge. In other words, 25% extra on the $100. Table B would be, or table 2 it's sometimes called, 50% extra, or $150. So you can see how it translates into premium dollars.